global markets shuddered on Friday, painting a grim picture as escalating trade tensions between the US and China sent shockwaves across the financial landscape. The catalyst? China's dramatic escalation of retaliatory tariffs on US goods, hiking them to a staggering 125%. This aggressive move mirrors the US's own 125% reciprocal tariff imposed on Thursday, effectively raising the stakes in this high-stakes economic battle. However, the reality is even more stark. The White House later clarified that when factoring in a separate 20% fentanyl-related border tax, total U.S. levies on Chinese imports now reach at least 145%, a figure that underscores the severity of the situation. The impact was immediate and palpable. European markets took a significant hit, reflecting the global interconnectedness of the financial system. London's FTSE 100 index dipped 0.2%, a subtle yet telling indicator of the underlying unease. The downturn deepened in Paris, where the CAC 40 experienced a more pronounced 0.9% drop, signaling a growing sense of apprehension. Germany's DAX fared even worse, plummeting by 1.1%, highlighting the vulnerability of European economies to the escalating trade war. The pan-European stocks Europe 600 index mirrored the negative trend, falling by 0.9%, painting a bleak picture for the broader European market. This market turmoil, however, has not shaken the Trump administration's resolve. Pete Navarro, one of President Trump's top trade advisors, dismissed the sell-off with a dismissive wave of the hand, characterizing it as a mere normal retracement after a big day. This nonchalant assessment, however, rings hollow against the backdrop of substantial market losses and growing global uncertainty. His attempt to downplay the significance of the situation contrasts sharply with the palpable anxiety felt by investors worldwide, who are grappling with the far-reaching implications of this escalating trade conflict. The situation is far from simple. This isn't just a tit-for-tat tariff battle. It's a complex geopolitical chess match with potentially devastating consequences for global economic stability. The 125% tariff isn't just a number. It represents a significant escalation of hostilities, sending ripples through supply chains, impacting consumer prices, and threatening the already fragile confidence of investors. The potential for further escalation looms large, raising concerns about a full-blown trade war that could cripple global growth and destabilize markets for years to come. The true cost of this conflict remains to be seen, but the initial tremors are undeniably unsettling. The coming days and weeks will be critical in determining the trajectory of this conflict and its impact on the global economy. The question remains, is this a mere retracement or the beginning of a much deeper and more prolonged economic crisis?